In 2024, the market did not get out of the gates the way we would have hoped, but we're also going to take a look at 2023 for a historical stock market stack up to identify what drove the market in 2023, how did we see things stack up across history, and what might that mean for the future. We'll talk about it right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome to the first Trending Report for the year 2024. We're going to be looking at data as the ending point of January 5th. That also gives us a great opportunity to look back on 2023 from a historical perspective, what I call the stock market stack up. We're going to identify how did the market compare to other opportunities that you could have invested in the last year. And then the market itself, meaning primarily the S&P 500, how did that stack up internally? So if we break down the subsets of sectors, how did that perform? What were the hot spots or the down spots or the up spots, so to speak, within the S&P 500? And then we'll also take a historical perspective of 2023 and how it compared to the history of the stock market in terms of other years and their performance. So with that being said, we'll jump right in. Here we are showing 24.2% return for large caps, meaning in this case, the S&P 500. Now, the S&P 500 performed very well in the year 2023. The only thing that beat it out of the major choices that are being illustrated in this graphic would be Japanese equities, and then coming in next in line below the S&P 500 would have been international, and from there we'll see U.S. small caps, which took a big run up there towards the end of the year as well. And then down at the bottom, we've got bonds at 5.8% and gold coming in at about 13%. And the only real negatives, the big negatives anyway, was crude oil, Chinese equities, and commodities, all coming in at about 11 to 12% negative. Now, when we look at the S&P 500, most people simply see this 24.2%. But the reality is the S&P 500 is made up of multiple different sectors, and each of those sectors can be tracked individually, meaning that some sectors perform better than others. Some lift the market up or lift the index up. Some actually drag the index down because it ends up being an average of the 500 stocks that it contains, which basically means an average of the sectors there. In fact, there is a weighting in the S&P 500, so it's not quite accurate what I said about an average of the 500 stocks. But when we look at the sectors, you can kind of bear that out and you can see which sectors performed better and which performed less, and how that kind of netted out to that 24.2%. So if we look over here on the right, this is exactly what we're seeing. We're seeing the sector returns for 2023 instead of just the overall return of 24.2%. And obviously, your eyes are drawn immediately to the upper part of this. The top three sectors, information technology, communication services, and consumer discretionary, they really led the pack. They lifted the market up. They were the three that came in above the average of 24.2%, coming in at 40%, 54%, and 56% comparatively. Now, on the downside, we see down here at the very bottom, we've got utilities coming in at minus 10%, consumer staples at minus 2%, and energy at minus 4 to 5%. And then in the middle, obviously, we've got the rest coming in. But as I mentioned a moment ago, the three that came in above the overall index were the top three of information tech, communication services, and consumer discretion. Everything else kind of brought us back down to this 24%, if you will. Then the next question becomes, well, how did that 24.2% compare historically against the previous years or all the other years on the S&P 500? So this kind of mountain chart approach is simply taking the S&P 500 and looking at its return each year and dropping it into a slot. And each of these slots is in 10% increments. So everything here on the right, if you look across the bottom, going to the far right, is going up is a positive return, 0 to 10%, 10 to 20%, 20 to 30%, 30 to 40%, 40 to 50%. Or if we go to the left, those are all negative numbers going minus 10%, minus 20, minus 30, minus 40, minus 50. So if we just take, let's say, the last 5 years, 2019 right here came in between 30 and 40%. 2020 is up here between 10 and 20%. 2021 right in here between 20 and 30%. 2022 is over here. That was our negative between minus 10 and minus 20%. And then 2023 right here coming in the last year between 20 and 30%, which we obviously know is 24.2% to be exact. The question is, where will 2024 come in? Now, the forecasters, the analysts, the economists they're predicting it coming in right here between 0 to 10%. Doesn't necessarily mean it will, but it's interesting to think of it in this manner. It's also interesting to see kind of how things are kind of displayed or displaced across these various returns. The number one column right here is 10 to 20%, followed by 0 to 10%, then followed by minus 0 to minus or 0 to minus 10%. So this is where the bulk of the returns end. To put this in perspective, if you remember the financial crisis, 2008, look where that is, way over here. So there's only 4 years going back 150 years here. There's only 4 years that came in worse than minus 30%, and 2008 was one of them. On the flip side over here, there's only been 3 years that has come in better than 40%, and we have to go back quite a ways to find those, 1933, 1935, and 1954. But 30 to 40% right in here, not a bad representation. So overall, the market has done very well over the years. The issue really is when you get those negative years, you want to make sure you don't lose that ground, because as you probably know, losing in the market requires you gaining even more to get back to where you were. So there's kind of an old test, or an old joke is not the right word, but an analogy where someone says, well, if we lose 50% this year and we gain 50% next year, where are we then? And most people will answer, well, you're back to 100%, but you're really not. Because if you lose 50%, you're down to 50. If you then gain 50%, you're only back up to 75. So it's just an idea to illustrate the fact that it's very important to avoid those losses when you can, because you have to make it up with more significant gains to kind of catch yourself back up. Now, let's take a look at the market data itself and what's been going on. So here we are looking at U.S. capitalization over the last 1 year. We're taking and looking at from the perspective of the visual. We take a look at the overall total stock market here, and specifically what you're seeing is, although this ranges from large cap down to small cap, we're seeing that overall the trend, the longer term trend of the money, has been bullish. It's been green. But in the shorter term, the swing and the range, as we call them, are coming back and tilting or leaning bearish. That's what these red dots and red numbers indicate. So what you're seeing from a trend perspective is it's large cap that's kind of leading the way, with mid cap coming in next. And then down here at the bottom, we're seeing growth. The key here is we're seeing all three. We're seeing large cap, mid cap, small cap. The S&P 500, the S&P 400, the S&P 600 are all here. What you'll notice, the common piece is it's the growth subset of those that is down at the bottom. And then if you come up here, you're seeing the overall index is up here at the top. You're seeing the Dow is up here, and then you're seeing some value up here as well. So it just gives you an idea of what's going on. But generally speaking, if we come down here on the trend, you'll notice that we are looking positive and bullish. We're seeing all this green, but then we've got this nosedive taking place on both the range and on the swing, where it's going negative, red, or bearish. In the sectors, it looks similar, but a little different, because if we look at an average weighting of the sectors, again, we're seeing green and then red. We're seeing similar again from a trend perspective. We see this nice positive trend here, but we're seeing this nosedive taking place for both the tilting towards bearish on the range and the swing. And then you're seeing certain sectors are holding their own better. So right now, financials and healthcare are giving us green across the board in unity. But then down here towards the bottom, we're seeing Vanguard Energy, or energy in general, I should say. We're seeing silver, we're seeing utilities that are coming in the lowest end of the trends. And then international equity. If we look at the total international market, we're seeing very similar to what we're seeing in the U.S. right now. We're seeing green on the trend. We're seeing red or bearish on the swing and the shorter term range. There's that range. Here's that swing coming in right here, red. And then yet we've got green on the trend. So kind of moving in unison with the U.S., so to speak. In fact, the U.S. is really leading the way because we put that in here as a comparable. And you'll notice the S&P 500 on the trend itself is ranking higher than all the international options that we've got listed here for you. And then finally, if we look at bonds, the total bond market is, again, looking almost like the stock market. We're seeing the green bullish trend. We're seeing the red bearish tilt and swing, or range and swing, I should say. And it looks kind of like we were seeing before. So the bond market's kind of been working in unison with the stock market as of late. We've got the trend right here swinging up positive. We had a positive swing and then this big drop for a bearish swing. And then right here, these dots are showing us the bearish range taking place. So all in all, when we look in here, we're seeing municipals and we're seeing investment grade, as well as some of the longer term treasuries are up here at the top. And then down at the bottom, we've got mid-year treasuries and shorter term treasuries, as well as total international bonds down here at the very bottom. So there's a lot going on. The market's kind of taking a bit of a pause or a breather, it seems like right now. The real question is, as we get legs underneath us in 2024, are we going to see things stabilize, or did we kind of start the year off on the wrong foot, so to speak? So lots of analysts, lots of economists always like to watch what's going on those first couple days of the year. Some argue that it sets the tone for the whole year. I'm not sure I really buy that. But nonetheless, the market was doing really well last month and then kind of stumbled a bit here at the beginning of January. So the question will be, will we regain our footing as we go through the rest of January and off to the remainder of 2024?
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.